The loan-to-value ratio, or LTV, is one of those cornerstone mathematical concepts that appears on the national portion of the real estate exam and serves as a primary tool for lenders to assess risk. To calculate LTV, you take the loan amount and divide it by the property's value. However, the first trap examiners set involves how that value is determined. On the exam, you must always use the lower of the sales price or the appraised value. If a house is under contract for $200,000, but the appraisal comes in at $190,000, the lender is going to base their LTV calculation on that lower appraisal figure. This is because the lender wants to protect their investment by ensuring they are not lending more than what the collateral is actually worth in the current market. Let us look at a concrete example to see how this plays out in a multiple-choice question. Imagine a buyer is purchasing a home for $250,000. They have $50,000 available for a down payment, and they need to borrow the rest. To find the LTV, you first subtract the $50,000 down payment from the purchase price to find a loan amount of $200,000. Then, you divide that $200,000 loan by the $250,000 value. This results in an LTV of 80%. Examiners love to flip this and ask you for the down payment percentage instead, so stay sharp. An 80% LTV means a 20% down payment. You also need to understand the implications of the LTV from a risk management perspective. A higher LTV indicates that the borrower has less skin in the game, which translates to a higher risk for the lender. If a borrower has an LTV above 80%, meaning they are putting down less than 20%, the lender will almost always require private mortgage insurance, known as PMI. This insurance protects the lender in case the borrower defaults. You might see a question asking at what point a lender requires PMI, and the answer is consistently when the LTV exceeds 80%. Another common trap involves the math when multiple loans are involved. Sometimes the exam asks for the combined loan-to-value, or CLTV. This happens when a buyer has a first mortgage and a second mortgage or home equity line of credit. In these scenarios, you must add all the loan balances together before dividing by the property value. If the first mortgage is $100,000 and the second is $20,000 on a property worth $150,000, your total loan amount is $120,000, giving you a CLTV of 80%. One way to keep the formula straight is to remember the phrase loan over lower. This reminds you that the loan amount always goes on top of the fraction and the denominator is always the lower of the price or the appraisal. This simple phrase helps you avoid the mistake of using the higher sales price when an appraisal comes in low. Examiners frequently provide both numbers just to see if you know which one to pick. If you use the higher number, you will likely find that incorrect answer sitting there among the choices waiting to trick you. Always look for the word appraised and the word sale and choose the smaller number for your calculation. Beyond the math, understand that LTV impacts the interest rate and the loan program eligibility. A borrower with a lower LTV, such as 60%, is considered a very safe bet and may qualify for better terms than someone with a 95% LTV. In government-backed loans like FHA, the LTV can go as high as 96.5%, which is another specific number you should memorize for the national portion of the exam. Remember that for the lender, the value of the property is their safety net. If they have to foreclose, they need to be sure the sale of the house covers the remaining balance of the loan. That is why LTV is the most critical metric in the underwriting process. When you encounter LTV questions on the test, take a breath and identify the three key components first. Find the loan amount, find the sales price, and find the appraised value. Once you have those, apply the rule of using the lower value and divide the loan by that number. If the question gives you the LTV and the value but asks for the loan amount, you simply multiply them. For instance, an 80% loan on a $100,000 property is an $80,000 loan. Being able to move forward and backward through this formula is essential for passing the math portion of the national exam. Every point counts on the math section, and the loan over lower rule ensures you never get tripped up by redundant data points provided in the question stem. Focus on the loan amount relative to the lowest available value, and you will master every LTV question the exam throws your way.